And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, everybody. Welcome to the Coach's Playbook. It's Henley weather in Chicago. It's officially
Jack.
Yeah.
That was quite the introduction.
Yeah, I know. I'm feeling amped up today because we have such a uplifting and cool topic because we're talking the psychology of fear and bear markets. So to get started today, I kind of wanted to go to the chart that is just something amazing. But first, Mick, I understand you have a trader shout out.
I do. Thank you, Jack. Hello, everybody. Shout out to John Manning, up 5,200, trading the NASDAQ today, and that's on 2 trades. So shout out to you. 5,200 is a great day. 52 handy, as I like to call it.
On 2 trades, no less. No, that's a great effort right there. So we talk a lot because our traders overwhelmingly trade the NQ, the ES, maybe a little oil. We don't talk a lot about the pound. But as we go into this conversation today, Hogue, I was wondering if you might be able to share the daily chart of the British pound.
But of course.
Yes. All right. Let's see if I can do it. Jolly good.
The pound has been getting pounded.
Please, Manga.
3, 2, 1. Here we go. There it is.
Here it is indeed. Oh no, as they would say. And what we have here is an absolute disaster of a chart, especially we are looking, if I'm reading this right, at daily bars, right?
Daily bars, yes. This goes back to basically March of 2020 right here.
Okay. So could we widen this out a little bit so we can see more detail of those last couple bars?
Yeah, we've got 14 months of lower highs and lower lows here.
Well, take a look at this right here. Those last 2 bars, it's up a little bit today. That is the fear. Oh boy. So almost a parity, by the way. I got down all the way to 104, right? Almost parity with the dollar. I've heard on the internet that if it's already happened to the euro, but if we reach parity, football becomes soccer. So just it appears some patriotic Brits came in and made sure that didn't happen, but who knows? Still could in the future. So what happened? The story behind this, beyond all the Brexit and inflation stuff that's been going on for a while, is the new government came out a few days ago and basically said that they are going to be very, they're going to cut a bunch of taxes, right? And they don't have the offsetting. So they're trying to stimulate the economy, essentially, while at the same time, their central bank is trying to raise interest rates to fight inflation. So what you have there are the 2 aspects of like what government can do, right? The fiscal and the monetary, and they're pulling in opposite directions. And so what the people who are trading this said was, this is a disaster brewing. There was rumors that they were going to have to come out with emergency full % rate hike or something. And they're worried because to pay for this stuff, they're going to have to issue bonds, which are at higher yields right now. And that's going to be expensive. And people are wondering, like, could that lead to some sort of default? And then what you see there is the reaction, the fear. We can put away the pound chart for now.
All I'm seeing here is it's time to plan a trip to the United Kingdom.
Oh, yeah.
Take advantage of our dollar strength. Because I think it's something that's worth noting on this too, right? Like, not only is the pound down, we have the dollar at strongest levels we've seen since 2002. So we're at 20-year highs on the dollar, near our all-time highs ever in the history of the dollar, trending higher as it relates to the pound. So we're we're in this unique situation with it. And then, like you said, Jack, this emergency, what do they call it? The emergency budget for the new plan that they're coming out with, and the costs of that creates exactly what you said: fear, concern, what's going to actually happen. I do think there are some potential opportunities, though, with their currency taking a hit like this. It may spur the tourism industry a little bit.
Yeah,
now that people are getting back out and living their lives a little bit more normal than we were in the last 2 years.
I regret buying my new home because I could have just bought Buckingham Palace, right? I think it's vacant now. So anyway, as that goes, let's get to what you guys actually trade. There's also fear going on right now in stocks. We're back around the lows of the last down move a few months back. And I think what I'd like to talk about today, and I know Hogue has some great stories from 87 involving this, is the trading psychology of bear markets, but even more basic, the trading psychology of fear and how that can affect your strategies and what you do. So Hogue, why don't you lead off today? You've been through some market fear before in the past. It's kind of when you learn who's there, who's sustainable, and who's not. So I'll just let you take away however you want.
Sure. Yeah, I've been through. Well, I wasn't trading, or I was a clerk in 87, which I still think was one of the scariest periods of my life. But the other 2 or 3 crashes we've been in since then, I've learned a lot about managing that kind of fear. I mean, everybody is looking for opportunities and looking for big opportunities in it, and I think that fear has a tendency to create urgency, of course, in what we're doing. And I think many people overtrade. I think a lot of people that have never experienced situations like this think that they already know what to do to trade, and I don't think that that's true. It's been my experience that the faster the market gets, the slower I have to go.
Mm-hmm.
You really want to be cognitive in everything you do and anything you do. And, it's nothing to be afraid of, because you can only do to yourself what you do to yourself. The market's not going to do anything to you. So if you are afraid of these markets, you're better off waiting for markets to realign with the strategies that you're already familiar with. You're, of course, going to be experiencing the fear of missing out in these situations. But I think that can be a very healthy fear, right? I think it can be an unhealthy fear. That fear of missing out is going to create you to think that you're going to be able to master these markets that you've never seen before, that you maybe never experienced. And it's a better idea, I think, to wait for better days that that align with your skill level, right?
Yeah.
When the markets crash, I don't do much, and I've been through it a few times. I'm very demanding in trade locations. I'm very demanding to only look for trades that offer cheap opportunities, and I still have that FOMO little devil on my ears saying, hey, you're missing this, you better get into this,
Mm-hmm.
And that's the impulses, that's you telling you you're going to miss the whole thing, and you're not good enough, smart enough, whatever it is, and you don't listen to that. Listen to the one on the other side that says, be patient, let the market tell you when it's time. You're not going to pick the bottom, you're not going to pick the top. Look for opportunities that offer cheap risk. And some of the best trades I've ever made in high volatility were only because they were cheap.
Yes. There's the FOMO gets amplified by the idea that there are huge opportunities there. And at the end of this, it's going to shake out, sort of like the Big Short syndrome. This is going to shake out. There's going to be a few people that made fortunes off of whatever happens going forward. The odds of you being that person are minimal, because I guarantee you there will be more people that really damage their ability to trade in the future and stuff like this.
Very much so.
For every dollar made, there's a dollar lost.
Yeah, the futures market's a zero-sum game, especially if that's what you're trading. Someone's got to lose it. Someone's on the other side of that trade. Dan, we both started trading at about the same time. So when I think of, so we didn't trade through the Great Recession. I saw it all. I actually went and shadowed. I remember I was applying for jobs out of college at trading firms, and I shadowed a trader at a firm I will not name, but he was up a bunch of money that day. It was one of those huge days back during then, 5% down, just massive moves every day, day after day. And he was up a bunch of money, but was still terrified because I said, like, wow, you're doing really well. He said, you had any idea how much money I'm losing on all the other stuff, all the other assets, all the other bets I've made? It's not a good day. But we were around for the flash crash. We were around for Operation Twist. That wasn't really that. Obviously, COVID. What do you remember, Dan, as far as your biggest fear moment?
Well, there's been a number of them. I mean, obviously, things are a little different for some of the crashes when you're on an option side, right? Like that increases volatility, and that actually is a good opportunity. So when there is that fear and concern in those crashes, it creates opportunity for the options when I'm over on the treasury side. But the big thing I want to talk about that I think is worth noting, right? John talked about 87 being one of the scariest times of his life. Huge break. But look at, I think if we bring it out a little bit and we look at the perspective of what happened then versus what some of these crashes that we see now that we're not feeling an impact because we're thinking about percentage and not total points moved, right? John's talking about back in 87, everyone kind of jumping out. I've heard stories from my dad back in 87. He was on the stock side at the time and how frightening that was. And I've heard all these things. And as we sit here today, we watch these markets move points wise bigger than in 87. And yet people are still thinking it's okay to be trading. And that's the one thing I want to point out is keep in mind, just because percentage wise, we're not hitting, limits and we're not hitting breakers and, your 401k is not taking this massive hit. Your financial risk is still on the line. Your daily trade money that you are using to try and generate however you want to look at it. If it's pocket cash, if it's, everyday spending, if it's your whole world, when we still see these, when you hear the Dow down 800, which John, what was it back in 87? Not even 800.
504 points.
504 points.
That was the crash.
We're in a true panic, and obviously percentage, that's a massive percentage.
Yeah. I wanted to give the numbers right here. So in one day in 87, the market dropped 22.6%, which with the S&P, let's say roughly at 4,000, that would be if we had a 904 point drop in the S&P.
When we look at percentage, but I like to think about it too, your actual financial risk when you're trading inside that, right? If we see S&P down 3%, that's a huge move. And if you're on the wrong side, or if you're trying to fight that, that's where things get a little bit different. So make sure you're always looking at it in that perspective. How much money am I putting on the line? And remembering in 87, when that Dow moves over 500 points, that sends panic in the world. Obviously, as markets grow, we bring in more interest. And obviously, that underlying value continues to increase. It's not this massive financial economic impact that we saw then, but there's still your impact on your own little pocket, or I don't want to say little, but your own pocket, and the cash that you're trading with can take that hit that could have taken in 87.
I'll throw this over to Mick, but first about that, what you said there, Dan, I think it's important to remember is that the nominal value of, say you're trading an ES contract, has increased so much in the last decade. But as you said, the movement in points, if you put on the ES, when the S&P 500 was at 2,000, the nominal value was 100,000. Now, when it was around 4,000, it's 200,000, right? So a 3% move or a 5% move is double the point move that it was 10 years ago or I don't know exactly when it crossed. And you can have these big percentage moves where during the Great Recession, I think the S&P 500 maybe lost 60%. It got back down to triple digits. I remember that. That was scary. I believe like the devil, I think
666.
Yeah. Somebody was really playing with that one. That's a fun bottom there. Mick, sent to you for any insights.
So I I think you did a great job laying out the story with the British pound. This is the last 2 days, Friday's session was a massive down day. Sunday's opening, massive down day. Scary times to be trading. I know the volume was pretty good there, but like anytime, and I was just thinking back to like you guys talking about the 87 crash, the flash crash and the Dow. I remember that these scary times in the marketplace. You were, after we brought up the Dow, I was thinking, what was a really scary time for me? And that was when, crude oil back in the 2008, 2009, went up to the $145 a barrel and then, came crashing down. I remember seeing $30 price movements in crude oil. At the time, the limit was $10, and there were multiple days where you get locked limit up $10, locked limit up $10, then, they expand the limits another $10. And that was extremely scary. Fortunately, never got caught up in any of that in a bad way. I always, traded off the dome or the price ladder, or the matrix, whatever you want to call it. And I don't want to have anything to do with these thin markets where there's very little bid, very little offer, low liquidity. They're trading 100 tick ranges, in a 5-second period. Like that's out of my comfort zone. So I've never put myself into situations with the high risk. I'm more scared of, I shouldn't say scared. I'm more conscious of risking money than I am of, putting on something that's too risky and hoping that it goes my way. Because in those kind of market environments, in this BP, the British pound that we saw over the weekend, I mean, you could be, and one of you guys said it earlier, you're talking about the timing, you could be dead right. But if your timing is off, you can get really badly hurt. You could be dead right. And if you're too over leveraged, you're going to have to puke your trade before it turns around. Now, when we did have that chart up, and I mentioned, 14 months of lower highs and lower lows. This has been in a bear market since it looked like July of 2021. We've been selling off. So the one thing that I kind of wanted to talk about, and John brought up FOMO earlier, and it's these people that might hear this news story and think that there's action going on. There's some great opportunity there. My own personal stance is hell no.
Yeah.
You missed the show. I mean, fear of missing out. Here you are looking at the Friday price action, the overnight Sunday price action, Monday's opening price action. FOMO, what's that? You missed out. It's been in a bear market for 14 months. And then, I know there's people out there that are like, oh my God, there's this news story. Yeah, but you don't fit into that, in my opinion. I don't really, it doesn't matter how savvy you are. The smartest people will say, this thing's already done its thing. It could go further down. Sure. It could rally up. Sure. You don't know, but I mean, I just would want to point out, like, you don't want to participate in something like this. Call me crazy, but, again, I always want to play defense first and protect my funds prior to, that's my number one job before trying to make any money off these opportunities. Sitting on your hands in many cases can be the best thing. And after over a year of selling off, why would you get excited over the price action of a couple of days?
Yeah.
Something to talk about, no doubt, but
Mick, you are absolutely right. You are crazy, but it's a great point. By the time the public finds out about a move like this, it's over.
Yeah. Yeah.
That was really well said, Mick. I think I'd like to just add into that. I mean,
thank you.
When you're saying,
Please.
you see these movements, right? It's all exciting. And if see it 14 months after it started and you want to jump in, like you miss 14 months of trade, but also like if you find yourself like getting excited to jump into it, you're entering into a market space at its most volatile point in a product you probably never traded. So there's a massive learning curve to trying to even get into that. It's going to take weeks, if not months, to just get comfortable looking at the movement of that market. And all of a sudden it's completely different than it's been. There's a lot of work that goes involved. It's not like we can just, bounce from product to product like it's nothing and act like they're all trading the exact same way. Yes, we can apply similar strategies, but we got to understand how those markets move. What are they reacting to? What is the underlying causes to some of these? What are some of the fundamentals? Because fundamentals vary across a lot of these markets.
Yeah. And to build on what you said, Danny, I mean, we have the ability to bounce around. I mean, we're all trading on the screen. Nobody's standing in the corn pit and, needs to run over to the financials room to do anything in the 30-year bonds or something like that. It's all at our fingertips. But yeah, if you're not familiar with trading something, just because there's some news there doesn't mean you want to go gravitate towards it. I like to think of those events, if these aren't markets you're trading, stay away from the shiny objects, because you'll probably jump in and, it's just not going to work out. Maybe it does. If it does, there is luck involved in trading. And if you catch a nice run, whether part of it's luck or not, or your timing was lucky, it can build a false sense of security for future times. And,
Sure.
You could have made, X amount on this one, but then the next 4, you'll, lose X amount and more.
I'd like to point out a few, that was well said, Mick. I'd like to point out a few practical things, a few levels to look at. So Dan, and you can go back and look at it. So I'm not hindsight's 2020 on the podcast last week. Dan and I have been noticing we've been making a lot of good calls lately, and I got to make a super cut at some point. But what we said was we made a bet for $5. We've done it before of whether the market would go to 3,500 or 4,000 first. At the point it was at 37.75, and what I said was, I picked the 4,000 side, but I said it's going to go test those lows from June 1st. And guess what? Today, right now, is an important level. We are sitting right now in the ES at the lows from the last move down. I think this is a super important inflection point here, where if it starts coming back, that could be the double bottom on it. But the level that I'm really looking at, that I think it's probably going to test, I'm going to owe Dan $5, is 3,400, which is the high before the COVID crash. And it's in striking distance now at 3,650.
Jack, I mean, if you're going to pat yourself on the back, feel free to pat me on the back on my crude call.
Yeah. Oh, yes. Dan also did call the crude move down into the 70s to hang out. Mick?
So, Jack, just want to issue a warning there. You said $5 bets, and thank you for the reminder. I had a $5 bet with Dan. You might want to stay on top of him. We did determine 8 days ago, last Monday, that I was right and he was wrong about something we discussed when we were at the Cubs game 2 weeks ago. I told him he could Venmo me, and I have no Venmo 8 days later after him admitting defeat. So just be careful there.
Oh, I will. Yeah, we'll settle it somehow. But just want everyone out there who's trading, there's still a lot of gas to the downside. Technically, I know a few weeks ago, it was the highest nominal value of put options that were bought.
Check your notifications, Mick.
Oh, he does.
I saw you down there playing on your phone. I'll check my notifications, Dan.
It's possible that as this market moves down, that's going to beget, with all those put options, beget more selling to hedge those. That's one thing. The second is, I don't think this is over until we see the VIX go much higher. The VIX is at 33 right now. I think we need a push. That's when I would be not calling bottoms, but more interested in it, is once the VIX spikes above at least 40, maybe 50. So that's my other Nostradamus thing there. Anyone else got any levels to share, or do we want to start wrapping up?
We can wrap up, but one more parting thing. Dan, thanks for making your payment. Jack, if you have any problems getting some money out of this guy, just call him out on live TV and he'll take care of it right away.
That's a great way to do it. I'm going to air all my grievances here just for a record. We'll see how that goes.
We can have our own Festivus.
Ah, yes. I'm ready.
Festivus for the rest of us.
I got a crappy aluminum pole right here that's holding this light that I can't wait to get rid of. Well, on that note, Dan, you got a quote for us?
I do. It comes from Sir John Templeton, an American turned British investor. So I thought it'd be kind of fun to go full circle here.
Yes.
For those properly prepared, the bear market is not only a calamity, but an opportunity. So even in the downside moves, there's going to be opportunity to be had, especially for us retail day traders. Don't marry your biases, look for those opportunities, trade when the market is setting up for yourself, and continue to look for opportunity.
Well put. Hogue, since you've seen it all, you take us out today.
Well, with all this volatility and some recent lows and all that going on, it just reminds me of my dear old dad who told me the market always looks the worst at the bottom and the best at the top. Careful out there.
We'll see you next week.